Testing. All right, for those in the back, we're going to go ahead and get started with the home ownership workshop. If you are going to participate, can you come on in? Is anyone left that wants to participate? So I speak loud naturally, so I'm not worried about the microphone. So for those that do not know me from my last visit, I am Delicia Lacey. I am the local chapter president for the Realtors of Metropolitan St. Louis, uh, which is a chapter of the National Association of Real Estate Brokers. We are here today, as Ms. Kelly said, we are here to make sure you're educated and you have the knowledge that you should have been previewed to many, many, many years. So I want to always start with the piece of the Bible. There's a scripture that's going to tell you kind of why we're here today. So Proverbs 24, by wisdom a house is built, and by understanding it is established. By knowledge the rooms are filled with all precious and pleasant riches. That is why we're here, right? By wisdom a house is built. We want to provide you guys with the knowledge, the education, the confidence, the empowerment that you can walk out of here today and confidently put together a plan on what you're going to do next. Maybe it's for, the next generation. Maybe it's for yourself. Maybe you aspire and have dreams, to own your own home, own a piece of land, invest in rental, whatever it may be. We are here for that. This team that you're going to see today is dedicated to you for now and as long as you will have them. So when we walk away today, remember, if you need phone numbers, cards, resources, please take time to stop and speak with them, shake hands with them. They are dedicated to you as long as you allow. So, and don't be afraid to talk. We like people that talk. All right. So a little housekeeping rules. We're going to go through the presentation kind of swiftly. It's probably going to take anywhere from 45 to 60 minutes. And then we're going to do Q&A after. So please save all questions that probably going to arise. I'm pretty sure plenty are going to rise to the end, and we're going to take plenty of time to answer all the questions you may have. I want to take time to say thank you once again, but I also want to introduce you to your presenter. So the one you probably already know, Ms. Kelly. She is a realtor. Obviously, she's going to help us out today. Ms. Marsha Park. She's our vice president. I'm sorry, Ms. Kelly is our secretary. We're Realtors in Metropolitan St. Louis. We have Sydney. He is a jack of all trades, but he is a member of the membership committee. He is here today. He is titled. He's everything, but he is here to support you. We have Mr. Deontay Cannon. He is the representation of Cadence Bank and also the Realtors of Metropolitan St. Louis. Who did I forget? I did forget Greg. I did that on purpose because he said we always forget him. So we have Mr. Gregory Fisher. He is all things insurance, which is a humongous important piece of the presentation. Because once you step out and you spend the money and you buy the home, we want to ensure, right, that you insure the home. Because you got to make sure you're going to have it for now and forever, and your family is going to have it. Thank you. Oh, see, education, Thank you. All right, so I am going to get off my soapbox because Delicia, as the president, can tell you all about the importance of this presentation all day, but I'm going to call up Miss Kelly Butler now. She's going to take it from here. Marsha going to go first? Or Marsha Parks is going to take over first?
Supposed to change this or leave it, or I'm good. I'm good. Okay. Good afternoon, everyone. I am ecstatic to be here with you today. Kelly and I will be sharing some portions of the home buying process with you. Is that good? Can you hear me? Okay. A lot of times, potential clients or home buyers are really afraid of the entire process because they're not familiar with it. They've never gone through it before, and they just don't know what to do. However, I want you to understand that you're not alone in this process. You have a home buying team. You're not alone. There's somebody that's going to be with you from the beginning to the end. You have a home buying team. You have a home ownership counseling. That's only if it's needed. It's not always needed. The home ownership counseling will provide counseling to you to ensure that you will be a responsible homeowner. They will provide grants for you, and grants can range anywhere from $2,000 to $10,000, depending upon the organization. You have the lender. The lender is there to assist you with providing the funds to purchase the home. You have the real estate agent, which that's me and Kelly's role. We're there from the beginning to the end. We're there. We will hold your hand. We are also counselors, and if you don't realize it, we do some of everything. So we are there to help you. We counsel people. They cry on our shoulders, and I'm not kidding. We have to really calm people down, and we don't have a degree in psychology. You have the home inspector. The home inspector will ensure that the condition of the property is in a good state for you, to ensure that you don't have issues with your HVAC system, foundation issues, and we'll go into all of those things later. You have the appraiser. The appraiser will ensure that the property has the right market value. If you offer a price for a property, the appraiser will ensure that the market value is there for that property. You have the surveyor. The surveyor will indicate where your property line begins and ends. And so many people will say, well, this is my property line. It starts from this tree to that tree. That is not always correct. And people have been really surprised, but that's not a part of their property line. So the surveyor will take care of that for you. We have the homeowners insurance agent. That agent will ensure that you have the proper coverage on your home in the event of a natural disaster, tornado, hurricane, etc. We have the home warranty company. The home warranty will provide coverage in case you have something to happen. Maybe your refrigerator is not working properly. Maybe your ceiling fans are not working. You have issues with your plumbing, with electrical. The home warranty company will come and you pay a service fee. It could be $75, $100. And if they cannot make those repairs to that item, then they will replace those items. I'm aware of people who have swimming pools. They've had their pumps replaced with a home warranty, refrigerators, freezers. So it's definitely worth having a home warranty as well. We have the escrow agent. The escrow agent will make sure that your title, the deed to the property, does not have a cloud on it, that it is a clear title. They can perform that type of work. So that is your home buying team. So feel very comfortable about going through this process. It's a very lengthy and it can be a stressful process, but you have all of these roles who can help ensure that it's a seamless process for you. We take on a lot of the stress. The first step in purchasing a home is you have to ensure that you're ready to buy a home. You have to make sure that you have money saved in your account. You have to have money for down payment, possibly, if you don't get a grant. You have to have money for earnest money. Earnest money is to, when you make an offer on a property, you say, okay, seller, I'm gonna give you this money to place in escrow so that you know I am serious about buying this property. The earnest money can be from $500 to $5,000. So you want to make sure you have money for inspections. All of the inspections that we recommend our clients purchase, it could be $1,000. So you make sure you have $1,000 for inspections. Make sure you have at least $1,000 for earnest money. So you might need $3,000 Also, you have to have a reserve in your account. Once you purchase that home, you don't want to have a empty bank account. So I would say, make sure you have $5,000 in that account before you even consider purchasing a home. Home ownership counseling, I talked about that a little earlier. And okay, you can't really see that there, but there are some counseling services. One here in this area is Madison County Community Development. I have their number there. They help with grants. They help with counseling. If you don't have a minimum credit score that's required by the lender, they can help you get to where you need to be to purchase a home and make sure that you're going to maintain that property once you purchase it, because once you purchase a home, that's not the end. There's maintenance there as well. And you have to be a responsible party with that. We have City of Alton. They are a credit money management counseling. They have grant funds available for the Alton area. And we're going to have a sheet that maybe, okay, we do have a sheet for you. It's like a cheat sheet, and you can contact these organizations if you have any questions in regards to counseling or grants. Also, Illinois IDA, Illinois Housing Development Authority. That's another good resource with down payment assistance, closing cost assistance. We have the Urban League of Fairview Heights, another excellent resource. So definitely take advantage of all of these resources. A lot of people are not cognizant that these resources are available to us. So if the resources is there, it's up to us to conduct the research. I have just an example. I know I don't have a lot of time, but I had a client that just closed on a property the end of April. It was a $250,000 house. She came to the table with $4.31, and the cashier's check cost $4. Yes. So take advantage of these programs. They are available to you. The first step that you want to do if you're looking to purchase a home or contemplating that, talk to a lender, get pre-approved. Realtors, we do not work with any potential clients that are not pre-approved because it's a waste of time for us and for the clients. Because how can you go and search for a home and you don't even know what you qualify for? That's imperative. So talk to a lender. Don't just talk to one lender. If you have a car and you have issues with your car, you're probably going to get 2 or 3 bids. You're not going to take the first mechanic, right? The first price. You want to compare prices. You want to do the same thing with a lender. You have that option to shop around. It's called shopping around. You have 30 days from when you go to one lender, you have 30 days to shop around without it really dinging your credits. So make sure you shop around. Various lenders have various rates. They have different programs. Which program will work best for you? It's all about you as clients. It's not about anybody else but you. And you have to understand that. Do what's best for you. And I give a quick example of one lender might say, okay, I can give you a rate for 4%. You shop it, go to another lender. They say, I might give you a rate at 5%. You shop at another one, 3%. Then you can either go back to the lender that's going to provide you the cheapest rate, or you can negotiate. Say, I just went down the street to, what's your bank? And they said they would give me 3% and you want to charge me 5%. Do you want to match that rate? If not, then I'll go back to that bank. So, just keep that in mind. Yeah, it is. You have to really, it's your responsibility to do that. And as agents, if you come to us, we will definitely guide you in that direction as well. Only the client can determine how much you can afford. The lender might give you a pre-approval for $200,000, and that's good. You qualify for that, but you have to make sure that you're comfortable with purchasing a $200,000 home. And what that pre-approval indicates is you cannot exceed that $200,000, but you can always purchase a home lower than that. I tell people, nobody knows your lifestyle other than you. So you have to know how much you can afford. Some people might like to travel. If you maybe get to that maximum $200,000, then maybe you can't travel. And that might make you a not very happy person if you love to travel. So you have to take that into consideration. Some people like to dine out, entertain, shop. There are various things that are in your lifestyle that only you are cognizant of. So please keep that in mind. Once you have your lender, and you have your pre-approval, the next step is to hire a real estate professional. Everybody doesn't work well together. You know, you have to feel that, I call it a gut feeling with people. And if that person doesn't work well with you, you don't have to hire that person, because you're going to be with this person from at least used to be 2 to 3 months, but now it's 2 to 6 months because of the way the market is. It's a seller's market. So you interview that person, just like if you're going to a job, then that employer will interview you to make sure that you're a good fit for that company. It's the same thing with you when you're looking for a realtor. They have to fit your needs. You have to feel comfortable with them. Interview them, go to Google them, because a lot of information is out on the internet. Google them, see their reviews, interview them. How long have you been in this business? Are you full-time? Are you part-time? Are you really serious about this business, or is it just about the money? Are you here to service my real estate needs? Why should I hire you? Tell me, why should I hire you? Do you specialize in a particular area? A lot of people want to know, do I pay your commission, or who pays my commission? Do I have to pay you to be my realtor? And the answer is no, you really don't, but sometimes you might, because there might be some buyer fees. But ask that question. Don't be surprised at the end. And also ask them for references. Just like if you have anyone to do work on your home, you're going to ask for references, and check those references out, because they will be candid with you. And at this time, I'm going to ask Kelly to come up and present her portion.
Thank you, Marcia, for all of that vital information about the initial part of the home buying process. What I'm going to do, again, I'm Kelly Butler. I'm going to present to you all some responsibilities that the agents have to our clients. Marcia, what you said about we're going to be there with you to the very end, that's exactly right, from the beginning to the end. We're going to hold your hand. We're going to counsel you. We're going to encourage you. We're going to lift you up. We're going to pray. We do it all as agents when it comes to our clients, because this process can, again, be very stressful. And real estate language is very foreign to some people who have never purchased a home before. And so therefore, the agent needs to be knowledgeable and experienced so that they can break down to you guys what exactly is going on, what this means and what that means. And so some of the things that we're going to do is advocate. We're going to advocate for you as far as, well, let me put it this way. The law says that real estate agents have a fiduciary responsibility to their clients to make sure that we take care of you guys the best way we possibly can. And people don't know that when they come to purchase a house. They don't know that an agent is going to advocate on their behalf and make sure they're good, taken care of, make sure they're knowledgeable, make sure they're led and guided in the correct way, or in the right direction, so that they don't, thank you. I had to follow behind Marcia. I was uncomfortable. I was going to have a crook by the time I got done. But no, we're going to make sure that you all are, definitely taken care of, connect you with the right people in the industry, give you all the information you need to be sure that you make the right decisions for your family, you and your family. We're going to negotiate for you. So once you get into the process and you find a home of your dreams or something that you want to make an offer on, we are the ones that gather all the proper paperwork and read the agent remarks and take a look at the finances, options on the property, things of that nature, to make sure that you're eligible to move forward with a contract. Once we move forward with the contract, we'll discuss with you about, what do you want to offer on the house? Some of the things that we do before you make an offer is we look at the market to tell you guys exactly what we see and what's going on. So if it's a 3-bedroom, 2-bath house in a particular area or zip code, we're going to go out there and see, what does this house sell for? What is the price range? And the price range can range from tens of thousands of dollars, but we will be able to present to you, hey, this same home or a home that's very comparable to this has sold for, let's say, $200,000, and let's say 6 months ago, and then here's 3 more that sold within the last few months for 230,000. So this house, you know, basically can sell anywhere from 200 to 230 plus $1,000. The agent is not the one that determines the value of the house. So we also explain that to everyone to let them know that this house has to be appraised out. But the information that we gather and that we present to you will help you make a decision on what it is that you want to offer for the house. Okay. And then once we put in an offer, if we're eligible or able to negotiate, the agent is the one that is going to correspond back and forth with the seller's realtor to come up on a price or a purchase price that is agreeable to the buyer and the seller. We also are managers. Okay, so throughout the process, we will also be managing the process of you purchasing a home. Once we go up under contract and all the proper paperwork has been put into place, then we will be the one that's corresponding back and forth with the realtor again, making sure that the agreement and the terms are executed within a timely manner. We'll also be directing you as a client to the very next steps to make sure you stay within the time frame that we are allowed within a contract. Because if we breach a contract, then the contract immediately becomes null and void once those deadlines are broken or unmet, or something is not actually done in the time that it's supposed to. So it's our responsibility to make sure that we stay within those guidelines and those time frames to be sure that we don't breach the contract and disrupt or interrupt the process of the home purchase. Also, the earnest money that she spoke of that you put up, that is something that can be jeopardized if, let's say, for instance, we breach the contract. So it is a huge responsibility that we stay within those guidelines. And I always explain that to my clients. Hey, your earnest money is on the line. Please make sure you respond to us in a timely manner. Please make sure you look out for your text, your email, check your voicemails, answer phone calls throughout this process, because between your agent, the title company, your lender, somebody could be contacting you needing information, and it's very important that we stick within those guidelines. So that's a part of the managing process. As far as guiding our clients, before we tour homes, we will take time to learn about what you want. I always do an initial consultation with my clients. So I will ask you, what is it that you're looking for? What meets your family needs? What's important? Make a list. A wish list is what I call it, of the things that you absolutely have to have, and then the things that you can do without. Therefore, when we are looking at homes and you see a home that may be a good fit for your family, in this day and time, you do not have time to think about it. You have to make a decision literally right away to be able to make an offer on a house and have an opportunity to win the contract. As far as the education part, we also are going to educate you guys. So I always tell my clients, by the time we're done with this process, you're going to be well informed and educated about the home buying process. You will not be intimidated or scared ever. And in the future, when you purchase another home, whether you use me or not, you will be able to do it with confidence. So throughout the process, you're going to learn everything and all about the home buying process in the different phases. So when I'm referring you to other professionals in the industry that you're going to need throughout the process, I am also giving you an overview of what they're going to do. And then I'm going to make sure you're connected to someone that you can trust, because I trust them. And believe me, over the years that I've been doing real estate, I've been licensed since 2006. I am very particular about who I use to represent my clients for me. So just know that my network is strong. You want to make sure any realtor that you choose, their network is strong. Marcia, we run in the same circle, so I know her network is strong. So just know you'll be taken care of. And then as far as the awareness, so throughout this process and deal after deal, there is something always new in real estate that comes up. Honestly, I can't really ever say that I've done a or dealt with a deal that was the exact same. It's always something new. And so from all of the new things that can pop up, problems, issues, or whatever, you gain new experience. And so we're very aware of some things that can come up during the process that could be harmful or hurtful to our clients. And therefore, we know what to look out for and also what to inform our clients about. I like to keep it real, as they say, and be very, very honest about what I see, what I think, and things of that nature. But I also always tell my clients, ultimately, I give you the information. It's up to you about what you want to do. But I can be honest, there's been some clients that are young that I've dealt with. I call them my babies. And I just absolutely just won't let them do certain stuff. I just won't. I will derail if I see you headed for, I would derail that deal if I see you headed for a brick wall or about to fall off a cliff. Okay, so it's not just about the money. You want to make sure your realtor is just not in it for the money and to make a quick sale. You want to make sure that they are looking out for the best interest of you. So we do more than just show properties. I have to explain that to clients because sometimes they just want you, they think that every text that they send out, you should answer within 30 to 60 seconds. They feel like every phone call that they make to you, that you should answer. And if you don't, you should call them back within 5 minutes. That is not the case. Agents do a lot more than run around and show houses. As again, and from what you can hear, we are managing other deals. We're managing several clients at the same time. We're showing properties on top of that. We're dealing with paperwork. We're talking to professionals all day long. And so therefore, we just ask our clients to respect that and understand that we do have your best interest at heart. And when time comes, we're going to get back with you and make sure you're good. Okay. And that's my portion of this piece. And from here, I'm going to call up Deontay Cannon with Cadence Bank, and he's going to explain the lender side of this process.
I'm short. Hold on. Hello, everyone. I'm Deontay Cannon. I am a community development lender / mortgage loan officer with Cadence Bank. Somebody said he who holds the money. That's probably me most of the time. I don't hold all of it, though, I promise. So I'm going to talk to you guys today about the 5 keys of home ownership. So the 5 keys of home ownership, the first one is job stability. Second one is credit history and score. The third one is available assets. The fourth one is going to be personal qualification factors. And the last one are the house qualification factors. So the very first one, going back, very first one is job stability. Typically in mortgage, we would love to see you guys have a 2-year job history. And sometimes you don't even have to have a job if you're retired, or if you're on some things like Social Security or disability or things like that. Believe it or not, you can still qualify for a home. What we're really looking for in the 2-year work history is just that you have 2 years of consistent income that's provable. The provable part is usually the biggest part because some people have cash only businesses, which is very hard to prove. But as long as you keep good documentation, that shouldn't necessarily be a problem as long as you file taxes like you're supposed to. One of the funniest things is people don't believe that you can use your education as a part of your time frame too. So I've done loans for people who were younger and older who had just gone through school and then had a job for a year or even a year, maybe 6 months. As long as we can show that you were in school long enough to get that degree that showed that you can do it, we can use that as actual job stability because you're in the same field that you were in when you went into that job that you were in school for. So you have the degree to show that you have the training behind it. We consider that a part of it. Same line of work. We love to see consistency in the same line of work. We would love to see consistency in the same job. However, it's not always required. What we're really working for here with this entire process is how do we tell the best, simplest story for you? If you have to tell me a story 15 different ways, I probably got to tell it again 30. And if anybody's ever played the telephone game, you already know. From beginning to the end, we have 15 different versions of the same story. So the more consistency we have with any of these things that I'm going to cover, the better. It's going to make it really easy to tell the story for you guys, because that's really what my job is. I'm the person in between you and basically the money, because the money, I call that the underwriter. The underwriter is the one who makes all the decisions and says this actually fits the guidelines, that you guys fit the guideline for the program that we're trying to do for you. So that being said, they're the ones who says yes or no, and they can also say maybe. Maybes are very important. Maybe say that we can have a little bit more documentation to help us out. So concerns when it comes to the job history. Concerns that we have may be that we had what we consider gaps of employment, which means that I was working for this year, I wasn't working for these next 3 months, then I went back to work for 6 months, and so on. We usually, like I said, we got to have 2 years of history. If we're going to accept it, even with gaps of employment, we have to know why. Again, we're telling a story, literally just a part of the story. So what happened? It's like writing a book and saying I was out of work and then I went back to work. You got to know what happened in the middle, like we're leaving us out here. So that's where that comes in. We have to at least be able to tell it. And usually if it's longer than 6 months, it has to be a really good reason why. Like we have to have something that really happened that put you out of work where there was no income coming in, that we had to change that. Those type of occurrences, they usually want to see you back in work for at least 6 months to a year. So job stability is very important, because imagine if you were loaning someone money, you didn't really know whether they're going to be going to work to be able to get the money to pay you back. I don't know. That's a hard give. As a loan to someone, that's a hard give. As a gift, it's an easier give, but as a loan, that's a harder give. Especially when you don't know if you're going to get your money back, because maybe you had that money set aside for that trip that we heard about earlier today. You know, we like to go tripping, so that's one of those things. But yeah, multiple employment gaps, also job changes. So it's the same type of scenario. So if I was here, then I was there, then I was there, all within 1 year, and we're looking at 2 years. That means you were here, there, and there twice. That's 6 job changes in 2 years. We can do it. Can't say we can't do it, but exactly, we got a story to tell now. We got a long story to tell. We're writing a novel at this particular point in time, and we're supposed to be in a short story. Our story is supposed to be 30 days long, and we're looking at 2 months. That's how it is. So we're trying to, again, keep it simple for you guys, because the more simple it makes it for you, the less headaches you have for me. So all you have to worry about is whether the properties are passing things like inspections and appraisals, which we'll get to. The math part of it, that's my job from the beginning, from pre-qualification. So that's what we're looking at. But everything else kind of leaves it to the other members of the team, including yourself, because we're all one team. So key 2. Credit history and score, everybody's favorite thing to talk about, but nobody wants to deal with it. Most of us know credit scores are usually 3 digits, and I say usually because sometimes they don't exist. Some people just have no credit, which is not the worst situation to be in. But they typically range from 350 to 850. Like I said, you can have what we call a no score, which is a 0 score, which means you literally have nothing, no history at all. And then there's also, your credit score usually can reflect your likeliness to pay money back. So it's just like what we talked about before. If you know someone probably had an issue with not necessarily giving people their money back, like the first few people that they didn't give their money back to, will you be the 4th person to give them a loan? I was just saying, that's how I think about this. It's literally how I approach this entire situation. So when we have these situations where credit might be an issue, it's like, okay, let's figure out what the history says. Because all we're doing is telling a story, trying to predict the future based off the past, which is always hard to do, but that's the only thing we have to go off of. So thinking about credit that way, usually that score reflects your habit, even if it's not just your current habit, because usually your score more so reflects the current 2 years of habit instead of the current year of habit when I finally got myself together. You know, that still be dragging along. But the lower the score, the less probable or the more requirement you'll have, the more expected, what we call those letters of explanation that you have to do to write your story. So that's more of a story we have to write when we start seeing things on the lower end, where it's things that we might get like collections that might be on your credit report, even with some of those medical ones. Usually medicals aren't as bad, but what you'll tend to find out is that they tend to hold down that number though. So that means when you could be qualifying for something a little bit better or better interest rate, like what we talked about before, now you're held down a little bit more and possibly pushed into a program that might not even be accepted by the person selling the house. So programs come up, usually there are 2-3 different programs that we look at on a generic end of it. There are what we call conventional loans, which usually is more widely accepted because it's not as constraining to the person who's selling the house. Then there are government loans. Government loans are by the government. They all have their different versions. The most popular probably is VA, which is for veterans. And the next one is FHA, which is for everybody. FHA is probably the more flexible one of all of them, honestly. But that's how a lot of people end up in that program, but it's a little bit more restrictive too when it comes to the property conditions and things like that. In the world that we're in now, it's a lot of things being sold as is, as the realtors could tell you. A lot of people selling as is, which means it's a little bit more difficult. They're not willing to do anything, or may not be more willing to do anything. So I'll put it that way. But all these things can be reflected from just literally from the credit score end, because on your end, if I don't qualify for anything better, I'll end up in only what I can get. And my goal, when you work with me, my goal is to make sure you can get the best thing for you, not for me. So like it was said before, I don't have to pay the mortgage, you do. So what you said is your guideline, that's what I go by. So if you only want to go up a certain amount, that's the only far I'm gonna go if I can even get there. So we'll work that out. Key three is available assets, another fun thing to talk about. So acceptable sources of assets. When we talk about assets, we're talking about how much money do you have saved when it comes to the bank's end. I know on our applications it asks about assets and it says different things like, do you have automobiles and all these things? It's great to have them. We're not going to put those in. We're going to, as soon as you put them in, we take them right back out, because that's not an asset that we're looking for. We're looking for bank accounts. We're looking for investment accounts. We're looking for retirement accounts. Anything that we can tangibly show on paper has that value to it already is what we're looking for. So we're looking to see, do you have these things? Like she was mentioning that someone had $4 and some change for closing. Well, we'd had to see that in the bank account to know that you had that $4 and something for closing. And we'd have had to see it over 2 months to make sure that you didn't have an unacceptable source, which is what we're going to get to. So that's from your own personal funds. Other acceptable sources, other acceptable forces would be things like gifts. You know, you can accept gifts, churches can give gifts, friends can give gifts, parents can give gifts, family members, non-relatives. I've seen a lot of different things. Also, nonprofits give gifts that might not necessarily be in the form of what we call a grant, which is technically a gift too, if you meet the requirements for what they want for your program. So there's different ways that you can handle the acceptable sources. So that's really flexible. I mean, you don't necessarily have to bring all the money yourself. Honestly, one place that people forget, especially in this environment, that a gift can come from, which is kind of not even called that, it's called a seller concession or a seller credit. The seller, they can literally give you money as a part of the paper transaction, which means they'll be taking slightly less just to help with the transaction. So that means there's less money you'll have to bring. So let's talk about the funny thing, unacceptable sources, cash deposits or cash in general. I come across people all the time because there is almost a distrust in the bank. I understand, I've seen it, where people don't like to either have their information out there or they don't trust it because of the fees and things like that. But unfortunately, if it's cash at home, how do I know where it came from? We're telling the story again, remember? It came out of my safe. Well, how did it get there? And the backup question to that is, so can you show me on paper that's how I got there? You can't really show me once you pull it out of the bank, because the funniest thing about money is if you walked out of the bank with your money envelope and the strong breeze hits you and the money went up in the air, I promise you can't go back in the bank and say, yeah, my money just blew all over the street. Can I get it again? They're going to say, yeah, if we take it out of your account. So think about that when we try to figure out where the money is going to come from. Who's holding the bag, so to speak? Where is it coming from? We got to know. So cash on either end usually is unacceptable unless we can literally prove where it came from, which is very hard to do. So that's going to be one of those things. And typically you cannot borrow for your down payment. What that means is I can't go to another financial institution and say, hey, can you give me an unsecured loan for $5,000 like that $5,000 she was telling us about before? Can I get a loan for $5,000? Well, what's the purpose of the loan? So I can go pay for another loan. How? Explain that to me. You can't do that. You can't take money from one lender to take it to another lender like that. There are different ways that some people may pull that off, but that's because they may have had some things that were already pre-existing, not something new. So you can't take money from something new to put it into something new like that. So that doesn't include what we call, like I said, our grant programs and our bond programs, which is, they're considered to be second mortgages, honestly, but they go away over time usually. So those are also loans from other people, but that's a part of the same transaction. It's not, we're going outsourcing to someone else to say, hey, I need money from you so I can go pay them. It's not taking from Peter to pay Paul. It's not doing that. So we're literally taking from a roundabout source or a nonprofit source that's helping us with your transaction instead of that. So those are allowed. But going to another one to get an unsecured loan, they're not going to accept that fund. So they will let you keep it in your account. You can have it, But when we go to try to figure out where your money's going to come from, if you had $10,000 in there and 5,000 came from that, guess what? You got $5,000 because we're going to subtract out that 5,000 like it's not even there. So that's the thing about unacceptable sources. We have to make sure it's legitimate, and we do cover the last 2 months of bank statements. So anything that we see that's considered a high deposit, we'll ask about it. You can explain those things, but again, those are things we just have to talk about. Key 4, personal qualification factors. Everybody likes to talk about this, but it's hard for people to fix it. It's debt to income ratio. Debt to income ratio is just a math problem. It's literally dividing all the debt that you have on a monthly basis plus the actual amount that we're estimating for the mortgage by what your monthly gross income. So the money that you're starting with before everybody take all their money for you, you end up with about half of it, that money. So we're taking it from the beginning and not from the end. So it's saying, okay, that's why we have limitations to that. So if you add all those things up and then you divide it by that income and the number comes up to be 35%, that's a great number. But if it comes up to be 75%, that is not a great number because most of us do not see 75% of our income. So that's the way we look at debt ratio. That's why they put limits on it. There are programs that are more flexible that will allow you to go past 50%. Most of them stop you between 40 and 45. But again, government programs like FHA, they will allow you to go a little bit past 50, but do I recommend it? Not all the time. Even when we're pushing up against the wall, what I call the wall, when we're doing mortgage and we're doing pre-qualification, which is the beginning, where you can figure out how much can I afford, I usually say leave a couple of percents there. And I usually can see it myself to let you know kind of where you're at, because that's important, because in this market environment we're in now, the rates are going higher and higher and higher until the sellers get their act under control. So what that means is what you could afford 60 days ago, it's not the same as what you can afford today. It's a little bit less. So we got to make sure we at least leave a little gap space in there to cover that part of it. Funds to close / reserves. That's just what we need to be able to show from the assets to show what we have for our closing. So what we're talking about when we say closing, it's not exactly like a car. It's a little bit more added into it, although they have extra things in there too. When we do a home mortgage, you're looking at the down payment is one thing. So everybody knows if there's a down payment, that's one piece of it. The next thing we have are closing costs. That's another thing that you have to pay for, or that needs to be paid for. I'll put it that way. Closing costs can consist of the bank's fees, my fees. It can consist of the title company's fees. It can also consist of if there were any realtor fees or any other inspection fees that need to be done as well. So everything will always be on paper. We always have to disclose everything. By law, we have to do it and within a certain time frame. And it's usually pretty fast. Usually within 3 days, we have to have all that information out to you because we don't want to go through unfair lending. We call it fair lending. So we want to make sure that you guys have everything in front of you from the beginning so you can continue to make conscious decisions. So the number we talk about for cash to close, we always use that pretty number. That's the number that's estimated all the way up until you get a final closing disclosure that says this is your actual number, which you need to bring to closing. So for example, like what she mentioned earlier about that $4.16, it would have said it on a closing disclosure, this is your last number, $4.16 is what you need to bring in closing. Yes, I would have laughed at $4.16 as well. I'd have asked if they could have took a money order instead of a cashier's check, but that's just $4.16. Yeah, because I paid 50 cents for it instead of $4 more. But that's just the way I am. But that's how it is when we talk about that. And reserves is literally what's my estimated mortgage payment? How many times can I make that out of the money that I already have after I pay cash to close? That's reserves. So if I have money sitting in a 401k, but I'm only using my checking account, I would probably show the 401k account just to show I have extra money sitting back, because as a bank, we love to see that you got extra money sitting there. I'm not gonna make you use it. If I don't have to, you don't have to use it. That's always let you make the decision anyway. We don't need it, we don't need it, but it's good to be able to show we have that cushion there. It's just like we talked about before. If you were loaning to somebody, you know they had a little money back, but they couldn't get to it as fast. Well, it's a very strong possibility I'm gonna get my money back from you anyway. So that's how that reserves part works. Being able to show that the rent or mortgage is paid and verifiable on time, that's just the thing about housing. If you're already making a housing payment, we want to continue to see that your history of making that housing payment, and it's not always required on every loan. It just depends on the program that you end up in, and even if where you're sitting at, it always depends on that portion as well too. So sometimes if you're at that higher credit score we talked about, they may not require you to show rental verification if you're renting right now. They may, but if you do have a mortgage, we do want to see mortgage verification if you're keeping that property. So those things all add into that debt ratio as well. Key 5, house qualification factors. So house qualification factors, there's the appraisal, which is basically that tells us how much is the home worth and is it in the up to par or as is appraisal, which means it's good to go from there, or is it subject to some work that needs to be done? Those are very detailed. I'll tell you that because I've seen a bunch of them. They're extremely detailed. They have lots of pictures. The next one is insurance, which in this particular situation, we're talking about homeowners insurance. So homeowners insurance is required on pretty much every mortgage loan that we do because we want to make sure our asset is secure, just like we want to make sure your asset is secure. So it's both of ours. You know, we sharing. Until you pay us off, we sharing. We don't move in, but we sharing. Lastly on here is inspections, which there are many types of inspections to get, which I'm glad this was the last thing to come up on my list because that brings us to Mr. Sidney. He's gonna actually cover the home inspection and probably a little bit more too. So I'll let Sidney come up for that.
Good afternoon. Under the home inspection section, is that better? Home inspection, typically when you use a home inspector, of course, there's a cost to that, but they're responsible for certain items as far as walking through the home. In this first section, it says a home inspector can protect you and your money by showing you where things are past their prime or if something is in great shape. The inspection is not for the lender, the real estate agent, or the seller. The home inspection is for you, the buyer. So they're your eyes and ears. You're not a professional. You don't look at homes every day. You don't know what to look for all the time unless you're in the business. So that's what you pay them to do to make sure. Now, a lot of times these are very detailed. They cover every aspect of the home, foundation, roof, attic space, gutters, downspouts, exterior. They get on the roof. They do everything. So you can ask them any questions. You can be there for the walkthrough yourself. Typically, you will be with your agent, and they can walk you through the home and everything that's involved. And you don't have to, but if there is a home that may need some repairs, you probably should be there. A home inspector can go in a new home and find something. Okay, so don't be alarmed all the time when you get an inspection back and it has different items. It'll have items in there that they recommend to be replaced or repaired, or other things that they just say may be of concern. So sometimes when that happens, you get a report back and you say, man, and so we want to say, hey, I want the seller to get all that fixed. That's not going to happen. That's not going to happen. So don't be alarmed. Your realtor will go through that with you and help you to make the best decision on that. Next is termite. That's also a part of the inspection as well. Some home inspectors do that. Sometimes they have somebody on their team that does the termite inspection, or WDI, which means wood destroying insects. It includes evidence of any wood destroying insects, including termites, beetles, carpenter bees, and carpenter ants. Okay, so sometimes when we see these bees flying around, it looks like regular bumblebees, but really they're wood destroying. They bore holes into the property, and so do some of these carpenter ants. Sometimes if you look at properties like under the bottom, the soffit, you'll see it looks like almost a perfectly round hole. And that's what they're doing. They're wood destroying. And so they may not be termites, but these other things destroy and eat wood as well. So there's an inspection that comes along with that. The next part of it is a sewer lateral. So to me, that's probably the most important aspect of the home inspection, because what they're going to do is they're going to open that up. They're going to put a camera down there and visually push that all the way out to the main, the sewer main for the city or wherever it is. Now, if you're outside of the city, you're buying something outside the city, it may have a septic system, which is totally different. So, but the sewer lateral, that's a very important part of inspection. If you don't get anything else done, you have to get that done, because In the cities, more than likely, those sewer laterals are made of clay connections many moons ago, okay? And they have roots and things going in there, and they're working, but that camera helps you to see what condition it's in. So some are in worse condition than others. It'll get down to a certain point, and you'll be able to see the actual roots there that are keeping that from flowing freely down through to the main system. This is something that's been fairly new, is a radon inspection. Radon is a naturally occurring radioactive gas that can cause cancer. So that's why they started doing it. It's something that happens organically, naturally. You don't even know it's there unless it's being tested. So that's what they do as a part of that. They bring in a machine after the home inspection is completed. They leave it there for 2 days, come back, and it gets all the readings to see what the radon levels are in that particular home. My part was quick. Right? Now we're going to hear from Mr. Greg Fisher, and he's going to talk about insurance.
How you guys doing? All right. I'm Greg Fisher. I've been doing insurance for almost 10 years now. And a part of the home buying process is, I think it's the most valuable part of it. And a lot of people say, why? Why do you need insurance? Because it's the most valuable asset you can ever purchase, especially as Black people. And you want to have that protection with that home, and we do it in several different types of ways. The one thing is, when it comes to the insurance part of it, just like when you're getting ready to go out there and pick a good real estate agent, the very moment that you pick that agent, you should be on the phone next, picking up the phone, calling the insurance agent. And the reason being is because in the insurance world, it's a whole different, it's a foreign world, just like the real estate world. However, with the insurance world, that a lot of people don't understand is when you have a home, the claims for the insurance follows the home. It does not follow the person, it follows the home. So what that means to you as the consumer, you have to go out there, get an agent. Soon as you find a home that you love, you go to that real estate agent, you hunt them down, you be like, hey, please put an offer in. Before you say that, call your insurance agent and say, hey, this is the address that I'm looking at. Can you look it up? We can look in our system and see if there's any claims on the house. Because if there, a lot of times you have a home that's brand new and you think you're getting a bargain of the day. Well, if there's a fire claim on that home, the insurance company is going to say, hey, look, that house is a high risk. We're going to charge you a lot of money for it, and we might not even insure it. So as soon as you get ready to start looking for a home, get your good agent. That's number one. Number two is, why do you need insurance? Well, it's because of things, natural causes, anything can happen. It can be a storm, tree fall on the property, whatever. Do you at that time, it can happen anytime. Do you have $30,000 sitting to the side? No, that's what your insurance is for. So when it's something to occur, you call your agent up, and then you put in a claim, and then we'll go ahead and take care of it without coming out your pocket. That's the main thing about insurance. Now, out there, what people don't understand is there's two types of policies that the insurance company sells. Like my man over here, he mentioned about what the bank want. The bank want you to have what is called a replacement cost policy. And the replacement cost policy, I'm gonna try to explain it a little bit. You have a home that's $200,000. And if the home is $200,000 and you paid $200,000 for it, the replacement cost is not going to be $200,000, because if the home is 10 years old, that's the value market of what it is. But if you were to break it down and then we had to rebuild it, every brick, every column, everything up, the labor costs, it might be closer to 300,000. So if we come back and say, hey, we're going to insure your home for 350,000, it's only 200, don't be alarmed. That's the replacement cost policy. And that's what the bank wanted to see. The other thing is, it's very rare, but if you have the cash to go out there and pay for a home and you pay the market value for that home, we can get you a market value policy. It's a lot cheaper, but in the instance of that house is totally lost, we're only going to pay market value. We're not paying anything else. So those are the two policies that we do offer. And with those policies, just like he mentioned before, when you have certain things are covered on that policy and certain things are not. People think because you get a homeowner policy, it covers everything, and it does not. That's when that agent come in and they say, hey, look, how much do you want to cover this home? Where do you want to be covered at? Because like he mentioned about the sewer, it's a huge thing. Some companies won't insure homes that's over built prior to 1950 because of the old sewer stacks. They won't cover that, and they're not going to mention that in the policy. But if it's important to you to get this older home, you want to make sure that piece of that policy is covered. And and you have to purchase extra insurance on top of that when that happens. So you might and every policy is different. So every insurance company, some insurance companies will insure that stack, some won't. Some say that they'll go out 50 feet. And they literally say that in the policy. They'll say, well, we'll go out to this part of it. The city is responsible for that. And a lot of times the city say, no, we're not doing that. That's your property. You have to, so as an agent, I have to come in and make sure that you're covered on all levels. And with today's policies, a lot of companies now do have home warranties built into the policies. We do that now. However, we also have warranty companies that do it as well. So like I said, what I do is I look at your budget, see what you want to afford, and I put it together. I say, hey, here's A, B, and C. A being the best, the Cadillac of it, and then you got B and C if you don't like that policy. And it's up to you and your budget. So like I mentioned before, when it comes to insurance, the unfortunate part of it is they have as just because you qualify for a loan on a home, you may not qualify for the insurance. And it's shocking, but yeah, because we look at criteria too. If your credit's bad, if that home is a high risk, if it's in the wrong neighborhood, I'm being honest with you, for everybody, because that plays a factor. If the insurance company have a lot of claims in that area, they're going to say no, or they're going to give you a price that's through the roof. So that's where my job come in. As an agent, I deal with 12 to 14 different companies that I work with. And a lot of agents are the same way. You get with somebody that's comfortable, that knows how to navigate through those different companies and speak the language, and then we can be able to help you out with that. But for me, as far as that's my part of insurance. I can be able to help you guys out. I'm here for you. Just give me a call and I can help you out. And I'm gonna bring my man back up here. He's gonna talk about the whole title side. That's the final piece of it.
Okay. I'm gonna round this off with the last piece, which is the title. Even though the title company is an integral part of the whole process, this is where you end up, where you sign the papers and get those keys, is at the title company. Okay, so what do we actually do at the title company? A title company is involved in examining and ensuring title claims for real estate purposes. The company verifies ownership of real property and determines the valid owner through a thorough examination of property records and the title search. The title company usually does an abstract of title. Okay, All of that is saying that when you write a contract, you give it to us. Okay. We go and research. The minimum is 40 years. We go back, search 40 years. That's the minimum standard, or should be anyway, 40 years or more, depending on what's there. We make sure that there's nobody that can come back and say, hey, my great grandfather added some of that. Now, Mr. and Mrs. Jones, that's my house. So when you sign at the title company, you're good, you're covered. The strange thing is this. Sometimes they ask you if you want an owner's policy at closing. I don't know why it's an option, because the lender is required. They require themselves to have a title policy. So what does that tell you? If they want one, then that means you should have one as well. But they give you the option to get one or not. It's the cheapest coverage that you can get with the biggest coverage. Okay. Let's just say you did buy that property later on, and for whatever reason, you didn't get a policy and something was missed. That person comes and makes a claim. You're not covered. So any legal back and forth that goes on, that's out of your pocket. If you have a title policy, which is a minimal amount, maybe $100. Okay. They're going to pay all your legal fees if somebody files a claim against saying that this is their house. You don't have to worry about anything. That policy is going to cover any legal fees pertaining to that, because we've said at closing, we're guaranteeing that there's nobody else that has any claim to this property. Okay. So if there was a mistake for whatever reason, you don't have to worry about that. They will fight to make sure that you keep your home. Okay. So that's the best thing you could ever do too, as far as insurance is concerned. That's why he was saying insurance is good. Insurance is, like they always say, peace of mind. It's not, it's what if, right? That's why you get car insurance. What if you get in an accident? Not that you're going to, but if you do, you're covered. So that's what this is as well on the title side. But everything in this process is very detailed and important. Everybody that's a part of this process is a professional. Like Kelly mentioned, people think that realtors, that's all they do is show homes. That's such a small part of the process, is showing a house. All this other stuff that we discuss is what really happens in the buying process. Just like when people get counseling, they say the biggest things, death in the family, a divorce, buying a house is up there with the stress level on us as human beings. It's a very stressful process. So being involved with professionals in all these endeavors, it really helps for things to go well. Okay, that's going to end the presentation. We're going to have our chairman come back up and offer Q&A.
Well, how was it? Well, all right. Well, now we've talked enough. Actually, about an hour, right? We've talked enough. It's going to be time for you to speak now. Ask any questions you may have. Please remember, no question is a dumb question, as they say. And if you feel like it's private, then just afterwards pull one of us aside and see if we can help and answer it privately. They're going to be happy to share their information, their phone numbers at that time. If you want to talk to them at a later date, that'd be awesome. But this was great. I hope you guys pull the good stuff out. Hire a realtor, right? When you're ready to buy land, home, all that good stuff, right? When you're ready to invest, just got questions, got mortgage issues, hire one. Because if you didn't know, there's actually 192 steps to the job. So as he said, we just don't show homes. I wish. Mhm. Oh, this is lovely. Oh, yes, and please text me. They can ask questions. I asked the young lady if questions do come in on the chat to please share because we'll answer them. So hire the realtor, get your pre-approval, the man with all the money, tell him to share a little bit of that so you can buy your house. It's so important. We never want to set you up for failure. Know what you can get. We take you out to see that $500,000 house. It's pretty and all, right? That's nice. But then we turn around and tell you all we can get for you is two. You're gonna be a little mad. So we do not want to do that. We want to be realistic as well as make what your dreams come true. Doesn't mean you can't have that $500,000 house. It's just not today. We're gonna buy the 200 and put you on that plan to get to the 500 later. That's what we're gonna do. The goal is to empower you, to get to all the steps in life, not just now. So, and then to get the insurance, as they say, title insurance, that deed gotta have your name on it. You don't want nobody taking that $1 million house away from you either. So make sure you get the title insurance. Make sure you don't let the tornado take it either. You can't rebuild it. So you're gonna call Greg, to get all you need. Yes, sir. Mhm.
Okay, so to go back to re-ask the question or to restate the question. So how do we use rental history, so to speak, to be able to use it as a part of credit when there's no credit history, right? Did I get that right? Okay, so that's not as bad as it sounds, actually. So what we typically will do is get what's called a rental verification letter from the actual landlord. And in that letter, it'll state that they've been living here for this long and they pay this amount of money and they don't miss payments. They missed 0 payments in the last 2 years, so to speak. If it's a situation where you take the money from your account and do that as well, but it's hard to get a hold to the landlord, but what you can also show is if you've been taking checks out of your account or having money drafted out of your account, then we can show the last 12 basically canceled checks, as we want to call it that, to be able to show I've been paying my rent for the last 12 months. Although the support, we're going to probably need that letter from the landlord to be able to say, yes, this is what they've been doing. That's how we use it, that part as a part of your history for that. To also back that up as well, if you're living rent free and you have no credit, which is common as well, which could be like a person living with parents and they've never built or established any actual credit. If you have bills in your name or anything that you're paying that you've been paying for at least the last couple of years, we can use those as well. So what that means is I can go back and I could go and talk to, for example, I know Ameren is one of our electric companies. I have the electric bill in my name, but nothing else is in my name. So I'm just helping out that way. I can go and get the last 24 months of history from Ameren and show, hey, this bill is in my name. I've been paying it for the last 24 months. They can show the history from them. They would just give you a list and show you all your payments that you made to show you that you don't have a balance. Otherwise, I've done simpler things outside of utilities because utilities are really good. Insurance is really good if you have that. But there have even been times where you've used Netflix accounts because you've been paying it for the last 2 years, just to show you do know how to make payments for the last 2 years. Yes. Second part. That will establish credit, but one of the things that's the biggest thing on your credit score in general that affects it the most from your history is the history. So if you're starting something brand new, you don't have very much history. So you will have to have it for a year or two to be able to even get your credit score moving to that place where you want to like it at. And then in the same time, you're only doing that for one account. But if you have multiple accounts that you did that for, then it kind of builds just as strong because you can show I can manage it, which I say probably don't go past 3 to 5 because that's a bit excessive when you get past that. And it becomes overbearing too. It's like I have to pay 7 people. Oh my goodness, that's a lot of people. But if I had to pay 3 people, I can say, okay, 1, 2, 3, here you go. But if I got more than what's on one hand, that's a bit much. That's how I think about it. But that'll help you build that history at the same time, or kind of off staggered in months, because sometimes everybody doesn't give you everything in 1 month. Sometimes it's 1 month, this place is secured, then that place might give me something the next month, but that person gave me something. Banks are competitive like that. They really are. Well, you can say, this bank gave it to me. Then they showed them my credit report now. Well, let me see what this bank will say, because right now my credit score might not be the strongest, but I've only had them for a month. They can see that somebody else was willing to take a chance on me with something, then maybe they'll be willing to. And usually they'll start off secured, which secured, for people who don't know, that can be where you're actually putting cash down to that particular bank to say, hey, I'll give you $250 if you give me a $250 credit card. And they're holding the money to secure it. So it's just like an auto loan where you go there and you say, okay, I'm gonna give you a loan to secure this automobile. In the event you don't make your payments, guess what? So whoever you gave it to is automobile. Same way with the cash. So that's how that part works. But yes, that can be used to establish it too. It just takes a little bit longer to do it that way. Let's go with it. Right. No, not like that, because of balance differential. Yes. To add to that too, that's an excellent point, and that is something that's become more popular now than it used to be. One of the things that the bank is kind of catching on to is that though. So one of the things that's come up in the more recent 1 year, 1.5 year history when in mortgage, if you don't have anything that's not an authorized signer account, then they're probably going to still ask you for some trade lines because it looks like you don't have any credit of your own. It's what they're starting to say now. Yes, you have built the credit score. The history is still important, but they want to see that you can do it too. So if you have for example, in that situation, instead of adding them as an authorized signer, if you're able to add them as a co-owner, which is almost the same thing, they're really close. Only difference is when I'm an authorized signer, I don't have ownership of it. But when I'm a co-owner, it says that it's mine too, even though I might not have a card to go with it. Similar concept, but it's just a different verbiage for it. If we see a co-owner account, you're responsible for it. It's the way we look at it. If you're just an authorized signer, I could take you off at any time. And it's no longer yours. So that's how they look at the ownership. And yes, you can still have those authorized signer accounts. And yes, they do build credit too. If there were other goals in mind outside of mortgage, like automobiles and things like that, where the rates to get, yeah, it'll work for that because they don't have those same restrictions like we do. So that's a really good thing, but that'll also get you to that next step, which could be buying that home. Now you have an automobile loan in your name that's yours, and that can get you to that next step of buying a house that's in your name too. So what was the other question? I love that question. I love it. I'm glad someone asked it. So That part is, it is 100% a myth, 100% a myth. First-time home buyers actually get more benefit. There are different programs that are designed specifically for first-time home buyers. And there are some, like, for example, the IDA program that was spoke about earlier, they have something specific for first-time home buyers. They kick in a lot of money, which means you don't have to put down 20%. You don't have to put down 10%. There are even programs, for example, with Freddie Mac Home Possible or Fannie Mae Homestead, I believe it's the actual name of that one too. The two different programs, they only require you to put down 3%. We have programs at the banks, different banks. If you ask about potential portfolio products, which is the bank house products, they may have a 100% financing program, which means I don't have a down payment. So there are different ways to work it out where you don't have to put down all your money. Let's go with the question in the back, and I'll come to the part. Second part. Oh, okay. Yeah, that's Mythbuster. Go ahead. Up there. Yeah, that's the, I'm gonna repeat that question as well too, because that's a very important question. So how do your student loan payments or your student loan debt in general reflect to your debt to income ratio, especially when they're higher? That's right. Okay. Couple different ways we answer that question. It depends on which loan type first. So if we're looking at conventional loans, they have a different set of rules. That particularly means that it depends on the status. So right now, we're all, I say we because I have them too, we're in that emergency forbearance that they just extended. What that means is typically if you had a payment plan set up before, so our income-based repayments are always important to me. That's the way I look at it, because they usually is the lowest payment that you could possibly make. I used to tell everyone to set it up if you can. If you were on an income-based repayment plan before, we'll take that in consideration when we look at those amounts that you were paying. So if your debt, for example, is $50,000, but your income-based repayment said you paid 12 a month, again, we're looking at monthly payment is what we care the most about. So if that's what it is, we'll take that for conventional financing. Now that's only if this only in that emergency forbearance, or if you're actually in that income-based repayment program. But if you're in just a straight regular forbearance, not emergency, we're going to take with conventional financing, which they just flip-flop these. It's really weird. Conventional financing now is going to take 1% of the balance of that entire balance. That's when that whole balance comes into play. So if it's that 50,000, we're talking about $500 is now your monthly debt for that student loan. That's 1%. But if we're talking about the government program like FHA, that what I keep telling you is a little bit more flexible. I'm glad they lowered this. They don't really care whether it's in income-based repayment or not or anything like that. What they'll say is it's going to be the lesser of two things. It's going to be the lesser of what shows on your credit report if it's a number, or sorry, the greater of two things. It's going to be the greater of that number from your credit report that shows this is how much my payment is, or a 0.5% of that balance. So for that same $50,000 I was talking about, now we're talking about $250. So it's almost a worst case scenario, but it could actually be a lot cheaper sometimes that way. Go ahead.
So the student loan prices, right? So when it comes to student loan, that 25% is the same. That is because student loan requires back people back. Most of us have so important. I think it's what we were told the other half. $1,000 worth. That's supposed to be a work. Makes no sense, right? If you want me to fit the type of education to go to a job that pays you for it, and not to even buy a home if you won't get it. So it makes no sense. So maybe I had a big so
Let me get it to a quarter.
We trying.
I'll take a quarter. Right. That's the backup to that. So that's actually a twofold part. So I'm gonna give you a really brief what he's talking about. So that 20% down payment that they're talking about is to eliminate two different things, actually. The mortgage insurance, which only covers the replacement for the bank or the investor, not even just the bank, it's the investor. So the person who's giving us the money to give you the money. That's to cover them. So they have that mortgage insurance that's not you don't need it if you put the 20% down. Also, it allows you to not have to do what we call escrowing, which is means we don't have to necessarily make you pay us your taxes and insurance money every month. You can choose to do it yourself, or you can let us do it either way. But then at that point, you have a choice. So those are two different benefactors when it comes to putting that 20% down. That's why a lot of people say you got to put 20% down. Yes, it will make your payment a little bit less, actually make it a lot less than what it would be if you only put 3% down. And that's just basic math. If you only gave me 3% or something, I got to pay for 97% of it. If I give you 20% of it, I only got to pay for 80%. Math says easy. Yes, my payment is less when I do that. It's not required though. Mm-hmm. Okay. Depending on that program, sometimes it's better to show it in assets than to put it down. Because again, like I said, you got that backup behind you that shows I'm firm there. I know I have the money there. Usually sometimes having those reserves, as we talk about, that usually helps a little bit stronger than sometimes paying all that extra money that you could potentially invest in other things to make yourself better round. But yeah, sometimes the program might require it. So for example, with FHA, if you have below a 580, instead of you only having to put 3.5% down, they make you put 10% down. It's what we call having more skin in the game. They want to show that you're more invested instead of just the minimum invested. All right, go ahead. Bitcoin is not one of those things that has risen up on the homeownership side yet. So I don't think they've addressed it yet. I know it's hard to show on paper, but I think that depending on which version you have. So if you have the type where you just invest in like the stock market, then it's going to look like an investment statement. So it looks like the same thing. So you can pull it out like you would a regular stock account, then you can probably use it as an investment statement. Yes. I'll give that to you.
Thank you, Mr. Cannon. We just held you hostage. Thank you. And I'm sorry, so loud. The answer to that is yes, because it allows them to be picky. When it's their market, right? Now I can pick and choose. When you have so many, right, to pick from, I got 30 buyers to pick from on one house. Why wouldn't I be picky? Why wouldn't I pick the loan process that benefits me more? That'll make it easier for me, right? So this is why, yeah. So now because of that, we see that the easier loan terms for a seller. On the seller side, the conventional loan is going to be an easier process. And we already know that there's less restriction for the seller, less requirements for the seller on a conventional loan. Even though, I mean, everything is going to pretty much probably go around the same, because there's still an appraisal and things like that. But that's why they have representation that educates them as well. But yes, FHA and VA loans, of course, will probably be second. And that is, yeah, what we're seeing. We're slowly seeing that kind of fade as we start to see a small shift. But yeah, they're being picky on what they pick and choose and allow. Yeah, you would be too. I mean, can be upset. You're gonna take what's less stressful on you, right? Yeah, that's just how it's gonna work. So just from all these lovely questions, right? I see an opportunity. If we're allowed to come back, Ms. Kelly will arrange maybe sometime later in the summer or fall. I think we should return if you guys agree. I see that we can really do an hour and a half class just on the money. We really can break down the money. Deontay, You know, I'm just volunteering them right now. Deontay, come back and give you a whole class on the money piece. And then really breaking down the opportunities and learning how not just to, you know, how to read your own credit, but how to repair or build your own credit. We really can do a separate, because that's a whole monster, you know, in itself. A separate class for that. If you guys see opportunity in that, you just have to let us know. Okay. All right. Well, I'm gonna, if there are no other questions, I'm gonna go ahead. Title. To sell it. Prior to death. Mm-hmm. Mm-hmm. We have a question to the right. Yes, ma'am. Well, we preached the house before the car, but that's all right. Everybody's situation is going to be different. To give you the appropriate answer, it's all going to be based on your debt to income. Your income may be able to cover a new mortgage payment and a new car payment. So everybody's situation will be different. So the smart thing to do is if you think you want to go ahead and start looking for a home, is to get with the lender. So get with Mr. Cannon, and he's going to tell you if your debt to income ratio is too high, that you need to pay, you know, what you need to do to be able to afford the home that you desire. Because maybe you can get pre-approved with the car loan, right? But maybe it's not the amount you're looking for. Maybe you desire something more, right? So the smart thing to do is to give it to a professional so he can analyze the numbers for you and tell you what you can and cannot. Somebody has a hand raised. I saw. It left you that quick? Mhm. Don't create them. Oh, really life changer, yeah. Exactly. This is why I say that I think you guys can really use the class, really, because we'll break that down, right? Because the interest rate is, because you can buy the house 5 times if your interest rate is way too high. I think we guys will benefit from the lending piece and the credit class, and I guess we can discuss that later. Before we wrap up, and I say all my thank yous to the presenters. Thank you to Marcia and Kelly and Deontay and Gregory and Sydney for being here. I am going to, as president, I'm going to relieve myself. I just want to say thank you for allowing us coming. Many, many more. So much education to give. Please do not be afraid to call us. This is what we're here for. We want to make a change in the community if you allow us.
Yes. Okay, so I just had a quick thought, because I know that when I spoke with Pastor Brown and when I also spoke about the seminar, I talked about the credit, if you need help with credit, things of that nature, that we can help you do that, investing, things, and that part. So we really didn't get off into that part. We really just spoke about home buying process. But as our president said, we can come back and do a class on credit building if that's something you want to do yourself. If it's something that you want someone to handle for you, reach out to me, because I know an excellent, reputable, God-fearing woman whose passion is helping people establish their credit, and also business owners establish their credit to get them to the next level. And so I'll be the person that you can contact for that. She's worked with a lot of my clients, some here in our church, and she literally can have your credit together to purchase you a house. Yes, like that. Is that what they say? Yes, like that. And so also, if you're interested in investing, maybe you purchased a home and now you want to maybe extend your portfolio, get off into the investing side, or inquire about that. Any of our realtors that you reach out to, me, Marcia, President, anybody, all of us are well versed on the investing side too, and can help you there. All right. Investing in property. Okay.